Good afternoon, everybody, and welcome to our Slicing Pie webinar. My name is Mark Ashton. I'll be hosting today. We're very fortunate to be joined today by an international guest. It's always nice to get an international perspective on some of the topics that we talk about. It's obviously been a very exciting and adventurous year in terms of everything from building businesses to simply surviving COVID-19. If you've made it this far, you've done very well, and I don't think anybody should be beating themselves up about what they've achieved as an entrepreneur. Just some general housekeeping before I introduce our guests. There will be a playback facility made available for everybody who is participating in this. The podcast will be available and a playback facility link will be shared. Big point about these webinars and the things that we do here is to try and encourage interactivity. I think we say that we've been webinared out. I think if you think about 2020, if it's not Teams meetings, if it's not Zoom meetings, webinars, etc., we're exhausted from it. So the intent is to try and create this as a platform for follow-up discussions, and we do look forward to engaging with you, taking your questions, and taking some of the discussions offline. The two guests that are going to be joining me today, Mike Moyer out of the US, he's the founder of the Slicing Pie methodology, and then Guy Addison, some of you will know Guy from previous webinars. He's done with us in terms of executive remuneration, company valuations, incentive structures for executives. And as I said, we want to make this interactive. We want to make this a follow-up discussion. Mike, maybe starting point before we get into the crux of this webinar, maybe just a little bit of background on yourself, who you are, where, and how you end up joining our call today.
Great. Thanks for having me. I really appreciate it. I am from Chicago, Illinois. I actually live in Lake Forest, just north of Chicago. Spent a little bit of time in Africa a few years ago, which I really enjoyed. I was in Cape Town, and among other places, presenting Slicing Pie. My background is I've been an entrepreneur most of my life, kind of in and out of real jobs and entrepreneurship positions, and I've been successful enough to be dangerous, but not successful enough to be retired. I teach at Northwestern University, and I have taught at University of Chicago and a little bit at MIT. My main topic is entrepreneurship and marketing and sales and entrepreneurship. Today, I operate a company called Fair and Square Ventures, which runs the Slicing Pie software and assets, along with a number of other books about presenting and trade shows and a little bit of college stuff. And I own a camping gear company that sells tents for Boy Scout camps.
You sound like our kind of entrepreneur, and Guy and I often get to talk about these things. And, one of the things that fascinates us is about the different entrepreneurs and the different kind of businesses we get to see. I mean, we've seen everything from medical cannabis through to energy drinks, through to specialized consulting businesses. So, it's one of the things that we really enjoy, being able to get different perspectives and maybe just building on these different perspectives. I mean, when you came to South Africa or Africa, I mean, what was your sense of the startup scene and the technology scene? I mean, did you get much chance to interact with many entrepreneurs here?
I did, and one of the things that struck me, which I'm not sure was very, very isolated or maybe cultural, was I got really big crowds, especially in Kenya and in Uganda. Like 500 people turned out for you usually don't get that big of an audience. Slicing Pie is kind of a niche; it's usually a little more intimate setting. And one of the guys said to me, I was asking the crowds, he said that it's really nice to have some objectivity to fairness here. And we don't always get that. It's a lot of ambiguity that faces. And that's certainly something that's true around a lot of entrepreneurs, but it seems especially true for these guys that are talking to me. So I really enjoyed the crowds and I really enjoyed the people, and I loved visiting the countries. It's the first time I was able to visit Africa and Kenya and South Africa. It's a beautiful country.
I mean, I think we're very excited about the startup scene, and I mean, I'll let Guy maybe give a little bit of context in terms of some of the things he sees. But there are a lot of entrepreneurs who are very much in love with the idea of starting up a business, and then there are these entrepreneurs who built real businesses. And in a market like South Africa, where access to market, it's tough to break in and start a new business, particularly because a lot of legacy issues mean that there's been vertically and horizontally integrated supply chains. The opportunity for new businesses to gain real traction, it's tough to get a startup going here. Guy, maybe, I mean, just a quick introduction to who you are and your relationship to Mike and the Slicing Pie team.
Hi, Mike, and hi, Mark. It's a pleasure to be with you. Thanks. Yes, Mike and I go way back in terms of our interactions regarding slicing pie, and it's really nice to see the methodology being promoted in South Africa, and we do hope more generally in Africa. My business, my day job is assisting clients with their corporate transactions. I run a consultancy that assists mostly corporate clients, let's say more advanced businesses with mergers and acquisitions, share structures, raising capital, due diligence work. We came across the slicing pie methodology as a result of our work in the startup space, where entrepreneurs and essentially partners or founders of businesses were going through some really tough challenges to try and work out what their business was worth, firstly, and that's what we do. We value companies, but also how to necessarily split away once things were starting to, let's say, get frayed at the edges. And whilst we've seen, and we love to work on businesses growing and expanding, it must be acknowledged, particularly in a year like this, that there's also a lot of pressure on businesses. And sometimes it's only when you go through those pressure times that you realize what you should have done in the beginning. So that's what really started my investigation of slicing pie, and how I got to find out about it is that there was an alternative. And I think Mike will share a little bit more about that alternative in detail. But we were really interested and have become close to supporting the slicing pie methodology in South Africa, because we'd like to see it as a real viable alternative for seeing entrepreneurism succeed in this country.
Yeah, Guy, I mean, I think that Marry for Love but Plan for Divorce, it's been
Yes.
one of these really interesting discussions that we've had, and we'll touch on a practical example of that in some of the discussions you and I have had. But Mike, I mean, what is slicing pie? What's the context to it? How did it all come together? And I mean, where did you find the name for it? I mean, I think it's a fantastic name. I think it's a very catchy brand to be able to look through it. I mean, maybe give us some context there.
Well, thanks for that. I appreciate it. I started my life interested in becoming an illustrator. So I like to draw a lot. And so I drew a bunch of pies and grunts and animals and things for the brand. So I do that from all my stuff. And I was trying to create a book that was approachable because it's basically a book about finance, and it's disguised as a book about something more exciting than finance. Picking up, splitting equity for businesses is not a very good title. So of course, in the United States, slicing pie is the pie is referred to as the ownership of the company, but all over the world is referred to in different ways, slicing the tart and slicing the cake and different things. I started it, I started on as an entrepreneur in college, and I was paralyzed with the prospect of bringing on partners because I was doing quite well, and I didn't want to split my profits with somebody I didn't necessarily have a relationship with. But there was no good answers on how to do this. And so I just ran it on a cash basis. And when I started my first company that had investors, I'd ask my professors and lawyers and people that knew what they were talking about and looking for answers on split. And no one could give me a good answer. It was always based on future predictions, like what's your revenue going to be, what's your sales going to be, what are people going to do? And I didn't know what was going to happen. So I started kind of a rudimentary version of slicing pie in my first business a few years, about 10, 15 years ago, or maybe a little longer now. And it worked fairly well, but I did some bad financing deals with the investors. And then I joined another company where it was a startup that we had an exit about a year afterwards. And I made quite a bit of money, which was great, but it didn't seem fair because I was only there for a year and the other guys that were there for 5 years that didn't do as well as I did. I didn't know who to give the money back to, but I was, it wasn't fair in my favor this time. And then I started another company where my co-founder, who is a sort of a senior co-founder to me, wrote some very small fine print in our contracts that allowed him to buy back our shares at market value if he fired us. And then he fired all the management team and took back their shares personally. So he personally got them back. And that didn't seem fair either. So I sat down and wrote the first version of Slicing Pie about 10 years ago. And there's a white paper. And I posted it on my website, on my blog, and on Facebook. And lo and behold, people started being interested in it. And the first book came out in 2012. And the second book came out in 2015, the Slicing Pie Handbook, which is a better version of it. And since then, it's been translated in about 10 different languages. It's been used all over the world. And I've yet to hear of a single situation where it hasn't solved the problem. Whereas the attorneys I talk to, and Guy, you might be able to talk to this, they find that 60 to 80% of their equity deals done traditionally does wind up in dispute that requires legal intervention, meaning the chance of your equity split failing is better than the chance of it not failing. But today, SLACI has always worked.
Yeah, I think, Mike, that's sort of broad measure could probably apply here in South Africa as well. I can say that the vast majority of startups don't make it through to break even without some fundamental change in the original plan of the founder when it came to splitting the equity. And I think that means that pretty much all businesses would ultimately fit into that. What you think you're going to start with.
Right, all equity splits change. They all change over time, whether there's conflict or not. They all change, but what Slicing Pie does is it simply gives you a framework for making the changes, where everything else is based on guesses about future events or predictions or rules of thumb.
Yeah, I mean, maybe Guy, you've also got some input here, but I mean, one of the things that we always see a lot of debate about is, you know, traditional valuation metrics. So, and you know, I can see a fundamental difference between South African equity versus US equity, and that's simply that if you look at, I mean, if you've got the NASDAQ and you've got a JSE listed, so JSE being the local bourse, you can buy a technology business with 20-year track record, and you can buy them on a 4 times earnings multiple, and they're paying you a 5% dividend yield. And you can find a local startup who believes that their valuation for their you know, the high growth SME is 20, 30 times non-existent earnings, or potential future earnings, if we want to be less cynical. But there is this issue that, you know, if you can buy a listed business with that kind of track record, there's the ability to convince an investor that you're actually worth 20 or 30 times earnings before you've landed your first client, and just because you have a good idea. US is maybe a little bit different because you obviously have a bigger runway for a lot of these startups. But maybe Guy, and then maybe I'll hand over to Mike to give some context. But I mean, you think that's a fair summary that when we look at local entrepreneurs, they simply have an unrealistic expectation of what their tech startups are worth? Guy?
Yes, I think there's so much to answer in that. I was on Classic FM recently trying to encapsulate that level of disconnect between the JSE and startups in terms of valuations and how that's necessarily ameliorated by the private equity VC industry. But 2, in the minds of entrepreneurs, between how they're going to necessarily raise the funding required within the business and how they're going to split that level of risk that they take on themselves with their partners. And really, whilst it's hard to say that there's one solution that solves all of those problems, my general view is that most businesses are not going to end up like Facebook. In fact, very few businesses will end up like Facebook. It is far more appropriate for startup businesses to adopt a pragmatic and realistic approach with their founders, and rather than try and think that they need to become the world's dominant social media platform. And therefore, the Slicing Pie methodology is really the best mechanism for those entrepreneurs that, even if they do run a very, let's say, topical or appropriate social media business enterprise that could go big, is the best mechanism for those businesses to really start out. Mike, I'd be interested in your comments there, particularly with, let's say, the very powerful VC private equity lobby in the United States, how that's necessarily coexisted with the methodology in helping startups.
Well, that's kind of the painful irony of startups, is that there's companies that have shown a long track record of success are valued less than the startups that have no track record and just a bunch of dreams. And it's painful to see that. And oftentimes companies think they're so powerful and rich that when someone leaves, the dispute winds up in a buyout for the person who leaves. So the founders are so, excited. They say, oh, instead of just dealing with this legally, we'll just pay you off to buy you out. And the person who leaves the company is the only person who ever makes any money on the company. So it can be a struggle. What Slicing Pie does, which I think is, I try to align people's interests in the model. And just to be clear about Slicing Pie, I consider myself as sort of a description of what's fair rather than me making up the rules about what's fair. This isn't my concept of what's fair. It's supposed to be, and it is just sort of a reveal of what's fair. And what's nice about it is it focuses you on profitability, because the pie basically, there's 2 times the pie will terminate. One is at profitability, break even, and the other is at Series A. but people can, will use Slicing Pie until the company is profitable, and it focuses you on profitability and salaries and fair market salaries and getting to an end point that's logical for a startup company rather than just, continued investment. And so when you reach that point, hopefully you produce something of value, intellectual property or customers or revenue, and other kinds of traction rather than just dreams of the founders. So in the U.S., as in most places, it's a pretty tight market for outside funding, and Slicing Pie kind of points you in the way of profitability. It also helps you focus on what VC is versus angel money. A lot of companies raise angel money, and they do premature valuations where they'll value it for their mom, and they'll sell her 5% for $5,000. They just made a premature valuation, which doesn't reflect reality either. So the key is to align interests and keep people on the same page.
Mike, I think you speak our language when you talk to profitability. I think that between Guy and I see the story plays over and over. The hockey curve and the hockey stick curve. This rush for clients or kind of access into the market. But the reality is that you need certain things to get you to profitability. And it's not necessarily funding, it's access to a client base, it's some form of intellectual property. It is that salesperson who's able to get you over the line. There are many intangible skills that get you to the big P word, the profitability. And very often it's difficult to value that contribution. We often say, well, bring me some money, I'll give you a finder's fee, or I'll give you a piece of equity for your money. But often it's that person who's able to bring some intellectual property to the table, somebody who's able to bring some a client or relationships to it. And these are often the things that are intangible and very difficult to value. And somebody might say, well, I need money, but actually you need a client. How do you kind of handle those kind of, how do you attach a value to that? Because both parties have a very strong view on what their strengths and weaknesses are.
Well, the fundamental concept behind Slicing Pie is sort of like gambling. Do you know how to play blackjack?
Yep.
So let's pretend that you and I are going to play blackjack as a team, not as opponents, but as a team. And we're going to winnings 50-50 because we're friends. We don't know how much we're going to win. We don't know how long it's going to take to win. We don't know if we're going to win. All we know is that we're going to split it 50-50. So we go to the table, we each put $1 on the same hand of blackjack. The dealer deals 2 aces. So in blackjack, you want to split the aces and double down, right?
Yep, that's correct.
So I'm out of money and you're not. So you put down $2 more to cover our bets. So now you've bet $3 and I've bet $1. We still don't know if we're going to win or how much we're going to win or how long it's going to take to win. The future is still unknowable. What we know for certain, though, is that you bet $3 and I bet $1. If we win that hand, does a 50-50 split sound fair?
Absolutely not.
It'd be 75-25, right?
Correct.
So that's a logical, obvious, unambiguous conclusion that the share of the winnings should be based on the share of the bets. So startups are the same thing, but instead of betting on cards, we're betting on ideas. And we bet time and money and relationships and facilities and supplies and equipment. Every time we contribute to a startup and we're not paid for that contribution, we're betting the fair market value of the contribution. So if I buy a plane ticket for travel and I'm not reimbursed and the ticket costs $1,000, I'm effectively betting $1,000 cash on that company because the fair market value is $1,000. If I'm worth $100,000 a year as a marketing VP and you don't pay me $100,000 a year, I am betting $100,000 in unpaid compensation. So when you look at fair market value rather than future value, you can always tell what the value is because everything has a fair market value. Most companies simply pay for people's contributions. They pay for their rent. They pay for their employees. They pay for their supplies and equipment, and electricity. They just pay their bills. So when you're not paid, you're betting that much. You're not betting more than that. There's no such thing as leprechauns. They're not magically worth more than that. And you're not paying less than that because you can't take advantage of people. You're always worth your fair market value. So rather than trying to figure out what my value add is, look at what my fair market value is. And a good example was, I used to be the head of marketing for a company that made fishing tackle boxes. And I got paid a salary for that job without equity. And I was happy with that salary. It paid me, it was a good paying job. During the time I was there, I invented fishing tackle boxes that made the company millions of dollars. So my value add was much higher than my fair market salary. However, it was my job to create awesome ideas. If I didn't have awesome ideas, I'd be fired. If I did have awesome ideas, I'd keep my job because I was doing my job, or I'd get promotions. So just because my value add was much higher than my fair market value, the fair market value is still what I was betting.
Yeah, I think I love that analogy, and I think it's very pregnant. We actually have a very interesting case happening in South Africa that's been going on for the last 10 years with one of the big telecoms on exactly this. So we can certainly contextualize it. I'm going to move on to we said up front, marry for love, plan for divorce. But maybe just before I do that, I mean, we'd love the audience to submit any questions. You guys are welcome to submit via the chat facility or the Q&A facility. And we'll try and field some of these answers or question and answer here. But this whole thing of trying to subsequently unwind a startup, all the investment in time, etc., it really does have this fascinating dynamic to it. And I think, whenever we see a startup business, everybody enters on the basis that they are we're all going to succeed, we're all going to be happy, we're all going to live happily together going forward. The reality is that once that kind of honeymoon phase wears off, you're trying to work out, do I actually want to be doing this? How much should I be contributing? What should I be worth? People promised they were going to raise X amount of money. The sales guy knocked on 100 doors, managed to find a few clients, etc. And the way a business always works out is you're never quite sure what you're going to get 12 months down the line. This kind of planning for divorce element is where real contentious issues start to come in, because I'll use a very practical example. We have a medical technology business, and the intent had been to raise some capital for it. We did the usual pitching competition cycle, etc. Not particularly successful in that space, but we did end up in a situation where we got the devices into one of the universities who were going to give some validation for it. They were going to go and they were using it for PhD research. And my argument to my co-shareholder was that has more value than the value of trying to raise some cash in it. And then we ended up in a stalemate, because their view was we need more money to expand. My view was we needed more customers to expand, and we didn't need to build any further. Ends up in a stalemate, and we can go, not so much worried about the shareholders agreements, but it was a case of, did this equity actually improve because there was a client base for it, even though there wasn't necessarily the revenue. There was some revenue, but not necessarily the projected revenue. Some thoughts, Mike, maybe in terms of examples that you've seen where you try and unwind these things afterwards and try and work out what people's different contributions were worth, and why your methodology is quite successful in that respect?
Sure, there's a number of things going on there. Often companies lead to founders go down the road, and they wind up in a dispute, as you described, and they don't necessarily know what to do. They have to split up, but they don't necessarily know what to do after that. So that's where the conflict comes up, and that's when there's often unfair payouts, for instance, and just conflict overall. So let me come back to that example. I'll describe what's called the separation or the recovery rules of slicing pie, the recovery logic. There's basically 4 reasons why someone can leave a company. The first reason is they can be fired. They can be fired for cause, which means that they were negligent or they weren't doing their job. When you're not doing your job, slicing pie, as many situations should be, there's always a warning first. Warning, fired. You got to give someone a chance to recover their behavior, to change their behavior before you fire them. If you don't give them a chance to recover, then it's called termination without cause. You're just firing them for whatever reason you want, which is fine. You can fire someone for whatever reason you want. That's your right. You can also resign for good reason. Resigning for good reason implies the company made promises to you that it couldn't keep. So it might have said, our product's going to be ready in 6 months and you can start selling it. 6 months rolls around, no product, then you have good reason to resign. Or we're going to raise money in 3 months and we'll start paying you salary. No salary materializes, now you have good reason to resign. So startups routinely make promises they can't keep. And if you do, someone can resign if you can't keep their promise, because that's not what they signed up for. And the last one is resignation without good reason, meaning you just resign for your own good reason. You walked away from the company. Maybe you got a job somewhere else you like better, or you couldn't afford to work for free or not. You can quit whenever you want, because it's, most countries are pretty free countries in that respect. So you got termination for cause, termination without cause, resignation with cause, and resignation without cause. In termination for cause or resignation without cause, you're essentially walking away from the business. You've made decisions about how you're going to behave that aren't compatible with the future of the business. You're going to walk away. In that scenario, you lose your slices in the pie for non-cash contributions, and your cash contributions turn into a loan. So you basically lose your equity share, as you should. If you're a solo founder and you walk away from your company, you lose everything. You can't expect someone to pick up the pieces for you. So it's a painful situation to leave under those circumstances, as it should be. If you want to participate in the winnings, don't walk away from the table. On the flip side of the coin, if you terminate without good reason, or you resign for good reason, you keep your slices in the pie, you keep your equity, subject to future dilution according to the model, but you keep your share. So no matter what happens, you always get what you deserve. If you walk away from the table, you lose your equity shares. If you get fired for no reason or terminated for no reason, you keep your slices in the pie. So whatever conflict happens, whatever situation happens, there's always a solution for it. So in the situation you described, where one person had one idea for one strategy, and another had an idea for another strategy, you can walk yourself through that model. Was the strategy changed in a significant way? Because that seems like a significant change. If it was, then someone can resign for good reason. If the strategy wasn't changed, they can terminate for no good reason. But they're always making decisions based on the decisions that they make, not the decisions the company makes. It's interesting. It's interesting to talk about divorce, by the way. I actually had a family do a slicing pie in a prenuptial agreement.
That's very cool. Guy, I mean, obviously you're familiar with the local example. I mean, anything you want to add on to that before I dive into some of these Q&A?
One point that came to mind quickly is in my interactions with Mike, and also dealing with clients that are looking at implementing the methodology, it's become very clear that the methodology works as intended. A lot of entrepreneurs and a lot of founders, though, want to take attributes or aspects of it and mold it into the traditional approach to fixing equity. And Mike, I think, will agree with me that doing that really is somewhere in between both methodologies and is a ticket for disaster. The methodology works. We shouldn't try and change it. And therefore, it's vitally important that the listeners to this webinar look at embracing all of the aspects. They may not think that it applies to their current circumstances. A lot of people go into businesses with these sort of honeymoon type views, but I think this methodology really encompasses and is able to satisfy most entrepreneurs, or almost every single entrepreneurial idea, project, business idea, if you use the methodology as it's intended. You don't try and game it or mix it up with something else.
Yeah, I appreciate you saying that, because that's absolutely true. It's not, what I try to stress is there aren't multiple versions of fairness. Something's either fair or it's not fair. We can't say that I have a version of fairness and you have a version of what's fair. One of us or both of us has to be wrong. So the model always works as it's described. Whenever I hear someone saying, "Oh, slicing pie didn't work," it's inevitably because they changed something about it. And the termination rules are often what people change because they're afraid of losing their job, as they should be. But they also should be afraid of quitting their job. So the slicing pie makes sure that's true.
Diving into the Q&A, and I mean the question, and I've combined a couple of questions that were pre-submitted here. But I mean the first one, and Mike, I'll put it to you first, and then Guy from a local context. But I mean the question that comes through is slicing pie legally binding, or is it something that is nice to apply? It's something that we can say, all right, we'll see what this outcome looks like, and say that's how we're going. So that's the first part of it. I mean, Guy, maybe you can also come in with a local context for it. So, question being whether it's legally binding, and two, whether or not it's something that you have to get agreement up front. It's not something that you can work backward and say retrospectively, let's go and apply this as our methodology. Mike?
Yeah, I have a couple comments on that. The first answer is that slicing pie is a decision-making model at its core. So whether your decision-making is legal or not is up to how you write the contract. There's no law against how you make decisions. Now you can make bad decisions that are fundamentally unethical or immoral and illegal, but slicing pie simply shows you how to make a good decision. That being said, in most countries, it can be written into contracts that are logical and reflect the sentiment of the model. In situations where the law is not compatible with the slicing pie model, for instance, there's some countries where equity is taxable upon issue, whether it has value or not. There's some countries that don't tax capital gains, but do tax incomes. They really look closely at those things. There are situations where it might incur an unfair tax, but just to avoid taxes isn't a reason to be unfair. And lastly, if the contract is incompatible with slicing pie, let's say you did a fixed split and it's 50-50 and you did a retrofit, which is a thing that people often do, it's called a retrofit. And slicing pie said it's actually a 60-40 split. Well, all you've done is given the 50% shareholder who's unwilling to budge the right to be a jerk. He has a legal right to be a jerk and say, I want to keep my equity. That person can do that, but they go in knowing what they're doing, which is being unfair. In my experience, if you are contested legally, slicing pie is a nice way to unwind that problem. But one of the first versions of slicing pie that I did, I had an employee who disappeared after 2 weeks of work and just didn't show up anymore. And 3 weeks later, he sent me a bill for $8,000. I didn't have $8,000. So the guy sued me. He went to arbitration, and I shared the basic rules of the model, and the arbitrator looked at it for about 10 minutes, said, this is clear what it says, and dismissed the case. So when confronted with fairness, once it clicks, people should get it, and it works all the time.
No, I can confirm that. I think from a local context, yes, we do have tax, company law, contractual law, mechanisms and ways of doing business in South Africa that we may consider unique. We share many of our ways of doing business with the UK and with other African countries. So whilst, yes, we'd like to think that we're unique, I think there are some localization aspects to the methodology that can be applied in South Africa. And we certainly feel that's where we can add value should someone want to use us and get our assistance. We don't mandate it though, and I don't think you need to use a third party if you don't want to. This is very much something that you can, by going to the website, you can work out exactly how it works. Mike's been incredibly generous with the level of support and resources that he provides for free on his website so that you can actually work out how it works. That's not the thing really that makes it work. It's the fairness and being able to make the right decisions. And for me, that's what makes it so compelling, is it actually helps entrepreneurs move their business to break even faster. And that should ultimately be your objective. You should be taking your idea, getting real world feedback on that idea, and getting your business to profitability as soon as possible. So slicing pie actually aids in that, and it facilitates a much better operating relationship with your co-founders and your partners, or as Mike likes to call them, your grunts. So if you want to fight whilst you're busy starting up a business, do it the traditional way. But if you want to get on with your partners from the day you start your business, use the slicing pie methodology and focus on serving your clients in your market.
Mike, using your retrofit example, I just want to build into this next question here. I mean, one of the worst agreements we typically see here, and the ones that lead to a lot of dispute, are these ones where I've got half, you've got half. But the situation that a couple of people have described when they submitted their questions is, let's say that we started with an initial agreement, or we started our initial valuation, and we thumbsucked and said, I've got 75 and you've got 25, and we then retrofit using slicing pie, and it actually turns out at closer to 60-40. I mean, it's a very awkward discussion to have with some people, to say that they are, suddenly their equity has decreased and somebody else's equity has actually increased. How do you facilitate that side of the discussion?
Well, it shouldn't be awkward. It should be a rational discussion. Without slicing pie, it's very awkward, because you got to say, I don't think you're worth as much as you think you're worth, and have a discussion about value add. And those are very awkward discussions. To tell somebody that what they thought they're producing is not what they're actually producing. But with slicing pie, it's a very rational discussion. And what I usually recommend is, there's a spreadsheet called the retrofit spreadsheet. There's a guide and a chapter in the book about retrofits. I ask people to sit down and go through the spreadsheet on their own with their own inputs, estimating what people's fair market values are, and see what the numbers are, and then come together and compare the notes and see if they match or where they're off. If they usually match pretty well, people are pretty rational about what their decisions are. And then they can go from there. If they don't match, that's when the discussion comes up. And one of the places they don't often match is when it comes to someone's fair market value. I may think that I'm worth $400,000 a year, And you might think I'm worth $80,000 a year. If you didn't have the conversation up front, that's going to be a big conflict going forward. And that's not an outlier example. There's often people think they're worth, $250,000 or more dollars a year, when then to a startup they're worth a lot less. So having that discussion up front is important. But even in those situations, a rational discussion can be had. If someone says, I'm a brain surgeon, I'm worth $400,000 a year, and the partner says, yes, but you're flipping burgers for our restaurant, that's not worth 400 grand. That discussion can be more rational. But in my experience, if you don't get slicing pie, you don't want to use it. So you got to wait till it clicks and you get your head around it and give it the time to set in till you realize it works. Once you realize it works, then the discussions are more rational. If you don't want to be fair, and there are people out there who don't want to be fair, that have no intention of being fair, then you're having a tough conversation. That's a good point to decide to terminate the relationship. And slicing pie can be used to unwind the relationships as well. There are ways to do it, even if people are all in agreement to make it work for people. And that's kind of more advanced skills for another time.
Gentlemen, I'm very cognizant of time, and your time is valuable as well. And as I say, we always want to talk about fairness of it. Mike, maybe a closing comment from your side, and then a closing comment from Guy.
Yeah, I encourage you to check out this model. It always works. There's always one version of fairness. And I've tried to interpret that model of fairness so that it works one way all over the world. If you can get your head around it and apply it properly, it will always work for you. I know it'll work for you. Don't go into a situation where your main goal is to cover your own butt. There's no clause you can write into a contract that's going to cover your butt better than slicing pie will. And my proof, at least in my experience, is that it's never fails that I know of without changing it. So please take a look at it. If it doesn't click, please visit my website. There's plenty of free tools on there, free spreadsheets, free guides, free videos. You can learn this without my help. But if you need my help, please contact me. I'm happy to help. This will always work. I promise it will work for you too.
Thanks, Mike. Guy, from your side?
I firstly just really appreciate Mike and the effort and support that you've given us, and thank you for hopefully starting some really great businesses in this country and hopefully this continent. I am equally as supportive of the model and its ability to create real businesses. I think it builds accountability and responsibility into the system as opposed to expecting it just naturally to occur. And we are happy to support as well from here in South Africa. People are welcome to make contact with us if they've got any questions regarding, let's say, South African tax and legislation specific stuff. I remember, Mark, in your initial brief, you were going to give away things related to joining us. So I do hope we've still got that book to give away.
Certainly do.
Looking forward to hearing who's the winner of that book.
Excellent. Thank you very much, Guy. Mike, thank you for your time. As Guy indicated, we do also have some giveaways for today in terms of entrepreneurs that have registered or have joined us for the webinar. So up front, we're going to, that SME snapshot tool is available for you to have a look at. I'm happy to take that discussion offline if you want to have a look at how that works. In terms of the attendee, we're just doing a draw from this side here. And random generator comes up with Marco Fisser. Marco, congratulations. We will be sending you a copy of the book from the Slicing Pie book. And as a reminder, I will make contact, Marco, I'll make contact with you after this webinar. Thank you very much for your support. And everybody else, just remind the playback facility will be circulated. We'll make the podcast available as well. And thank you very much, Guy and Mike. Thank you for your time.
Thank you very much for having me. And again, thanks for being on board with Slicing Pie, guys. I really appreciate it.
Thanks, Mark.
Have a good one.
Cheers, gents. Bye for now.